Welcome to Money Matters TV. We have a terrific show lined up for you today. I'm Patricia Dunn from Merrill Lynch Wealth Management, specifically the Dunn Wealth Management Group in West Conshohocken, Pennsylvania. And today my co-host is Ken Jordan from Freedom Mortgage. Welcome, Ken.
Thank you, Pat. How are you?
Fine, thank you. And our special guest today is Paul Visokey from Stony Hill Advisors, who has some very interesting things to say about getting a company ready for sale. But I thought I'd start off today with a question that seems to be repeatedly coming up and being asked of me. And that is, who needs long-term care coverage? And of course, whoever asked me this question is hoping that my answer will be, well, you don't, because you'll be lucky enough to pass away in your sleep or get hit by the proverbial bus. But in 45 years of practice, I have never had a single client hit by the proverbial bus. So the answer really lies in the fact that 6 out of 10 of us over age 65 will incur long-term care expenses. So the question is, who can afford long-term care coverage? And I do that based on net worth. If you have financial instruments, and I'm talking IRA accounts, I'm talking stocks, bonds, and mutual funds, I am not talking about annuities. Remember, I've said repeatedly, annuities are not an investment. They are a future income stream. So excluding the annuities, if you have less than $1 million in liquid investment assets, then unfortunately, you cannot afford long-term care insurance because it would just plain take too much out of your net worth to pursue this avenue. You're more likely to be borrowing against the value of your home or doing a reverse mortgage, or hopefully have family members who can care for you. If your liquid net worth is between 1 million and 5 million, then most certainly you should purchase long-term care insurance because you have enough to be able to afford a comfortable retirement lifestyle and possibly, depending upon how large this is, may be able to leave a legacy for your children. However, a prolonged illness for you and your spouse could wipe you out to the tune of $500,000. Typical long-term care expenses run about $250,000 per person. If you have over 5 million in liquid investment assets, remember, we're not talking real estate here, liquid investment assets, then don't bother. You don't need it. You can self-insure. So once you know whether or not you need to buy long-term care insurance, the second question is, well, how much does it cost? Well, certainly the younger you are when you take it out, and I advise clients to start thinking about this seriously at about age 45 on up. There have been 3 ways. One was a pay-as-you-go, where you paid an annual premium. Those policies pretty much do not exist anymore. And if you find one, I would be very dubious. The second is once and done, where you pay a very large premium, and I'm talking $50,000 or $60,000 once, and you get coverage for the rest of your life. And if you do get hit by the proverbial bus, your estate will get the $50,000 or $60,000 back. The 2 10,000-pound gorillas in this market are Pacific Life and Lincoln Financial. Then there are 2 other ways, but I would ask you to talk to your financial advisor about it because they're complex. One involves the use of life insurance and one involves the use of annuities. So that's the skinny on long-term care insurance, which is a question that I'm asked a lot. And Ken, you were telling me that you're being asked a number of questions.
So the industry is in an interesting time, Pat. So what we're facing right now is a shortage of inventory, and really in our neck of the woods, which is southeastern Pennsylvania or the Mid-Atlantic region, there is an inventory shortage, and what's happening is that we're running into a cycle where buyers don't want to necessarily put their house on the market because they're afraid it'll sell, which it probably will because they're selling so quickly. And then they may not find a house to buy right away because the inventory is so low. So we're in this weird dynamic where, people won't put inventory on the market because there's not enough inventory on the market, But the question I keep getting is, how can I buy before I sell? And, for a lot of folks, it's not as big of a challenge as you might think. One of the things that you have to consider when you want to buy before you sell is, number one, can you afford to carry both payments? That's obviously critical. Because if something does happen and you're not able to sell right away, can you carry it for a couple of months? The second is, do you have the down payment and closing costs to purchase the new house without the proceeds from the old house? And that's the real struggle, because most folks that are buying up or in the real estate market where they're buying and selling, they typically need the proceeds from the sale of their house in order to purchase the new house. And one of the things that you and I were talking about, Pat, was the possibility of maybe creatively looking at a retirement account to solve that problem. And, if you have a house to sell and you're able to tap into your retirement account, at least for a portion of the down payment and settlement costs, then you might be able to accomplish just that. So I'm going to turn the tables on you, Pat. Can you tell our folks what it means or what the ramifications are, or wrapped around potentially borrowing from a retirement account, specifically a 401k or an IRA, or the difference between the two?
Happy to. The 401k is your best bet, because we're not talking a first-time home buyer here. We're talking somebody who already owns a home.
Correct.
And the first thing you have to do is ask your employer, does your 401k plan include a loan provision? Not all 401k plans do. It depends upon how it was set up in the first place. But if your 401k at work allows you to take out a loan, then you can take out up to $50,000 or 50% of the balance in the 401k, whichever number is lower. You can then use that to go out and buy a house before you put your other house on the market. Mm-hmm. And when your house sells and you get the proceeds, then you can turn around and tell your employer, I want to pay back my loan. Now, there'll be interest involved because you're paying yourself back, and you do have to pay yourself some interest. But generally, it's 5%. It's not a big deal. Now, an IRA, on the other hand, does not have this luxury. This is strictly a 401k deal. Okay. On an IRA, you can take out for first home buyers only. And by definition, a first home buyer is either somebody who never owned a home or somebody who hasn't had a home for 3 years, been renting for 3 years, and now wants to buy a home. They can take out up to $10,000. And of course, as you know, $10,000 isn't going to do much in the way of a down payment. So
it's not the IRA. The IRA route may not be as strong as the 401k route. Certainly, I think that what's also important to understand is that some mortgage companies will allow what's called a recast. A recast says, okay, if I'm going to sell my house for $100,000 in proceeds, but I'm only allowed to borrow $50 from my 401k. If the 50 is enough to put a down payment and closing costs and purchase the new house, when I get the 100, I can repay the 50 back to the 401k provider, and then I can put that other 50 down on the mortgage, and the mortgage company will reset your payments as if you put that $50,000 down to begin with. and they'll re-amortize your payments. So it is, not all mortgage companies, not all servicers allow a recast. So you're going to want to find that out. But it is a really great way to use that short term, and I stress short term solution, because Pat, you had mentioned if you were to move jobs with this outstanding debt, that's a problem, right?
Absolutely. I'm glad you brought that up. The last thing in the world you want to do is change jobs when you have an outstanding loan against your 401k. The grief and havoc and tax consequences of that are quite severe. Mm-hmm. So please don't be thinking about changing jobs when you're also changing houses.
Yeah, I tell my folks that all the time. Changing jobs during a mortgage process is not fun. The other solution that people have looked to for short-term financing is lines of credit. If you have a line of credit on your primary residence that you're able to tap into, you could potentially use some or all of that line of credit as the down payment on the new house. But what's important to remember there is if you're borrowing from a line of credit, we have to count that debt in the overall debt to income ratio. So the affordability question, really has to be looked at closely. Whereas if you are borrowing from the 401k, we don't have to count that obligation in the debt to income ratio. So it could give you a little more flexibility as opposed to borrowing on the home equity line of credit side. But it is an interesting, it's interesting right now what's going on with the inventory, and agents are scrambling to put together extremely strong offers the best they can. And they're looking for creative ways to help their buyers get into homes when they're competing with potentially 4 to 7 to 10 other offers on the house.
Well, that leads us right into our viewer question. Are you ready, Ken?
I sure am.
Well, Edward Mason from Ardmore has asked, how are mortgage rates set?
Well, so there's two ways to answer that question. And the short answer is interest rates or mortgage rates are essentially conventional agency or FHA rates are based on the supply and demand of what are known as mortgage-backed securities. Each mortgage company has a strategy on how they're going to hedge their portfolios, or their pipeline of locked loans versus how the mortgage bonds are trading. But I think a more relevant answer to that question is, how are your mortgage rates determined? A lot of folks don't know that your mortgage rates are determined by a number of factors. How much are you putting down? What is your credit score? What is your product type? What is your property type? What is your occupancy type? How long do you need to lock the rate? What's your loan amount in some cases? Are you purchasing or are you refinancing? These are all questions that come into play to determine what your actual interest rate's going to be. So when we see advertised rates, it can sometimes be a little bit confusing. Now, regulators have done a very good job over the last couple of years making sure that the industry puts the correct disclosures in advertisements so that people understand what draws that particular interest rate. But at the end of the day, your interest rate can be unique to you based on a number of different factors. And that's why it's always important to have an early conversation with a mortgage professional so that you can get a feel for how your particular situation is going to play out and how it will apply to your interest rate.
Fantastic. Now, if our viewers out there would like their questions answered on Money Matters TV, have your pencils ready, because this is how it's done.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. And now for our special guest, Paul Visokey from Stony Hill Advisors. Welcome, Paul.
Thank you.
I'd like to start with a question. I know that you're a mergers and acquisitions advisor that serves lower middle markets privately owned companies. Can you share with our viewers what issues are most concerning to these business owners as the effects of COVID-19 have impacted their business?
Yes, definitely. This has been a very interesting last 12 months. And literally, it's 12 months ago it began. Businesses in general, and these are the main kind of businesses we work with, whether they be small manufacturers or retail, or in some cases restaurants, they've been impacted by the pandemic in either of two ways. They've been very badly damaged, a la restaurants, or they have pivoted and they're doing very well through this process. And they're looking at the winding down of whatever they're making that came new to them, like plexiglass or masks or fluid to sanitize things. So that's all going to go back to normal by probably late this year.
Paul, I have a question. So mergers and acquisitions, in the mergers and acquisitions market coming into 2021, other than COVID, we can almost not go a day without talking about how it's impacted business. But other than COVID, what are some of the other trends you're seeing in 2021?
It's a process of recognizing where you are as a business owner in your career and your ownership of your company. If you're in the baby boomer generation, you don't have many more years to continue at the pace you're on, either for health reasons or just it's time that you need to think of retirement and look at other things you want to do the rest of your life. And these people are now facing that fact. They're also looking at the economy, and we're anticipating a rebounding 2021. We're looking at the very low interest rates, so there are loans available and buyers for your business right now. So almost like you were saying in the housing market, there's a lot of frenetic activity going on. And then lastly, kind of overhanging is all the money is being spent to repair the economy and address people's issues in the last year, many trillions of dollars. That has to come back to the federal government in some time over by raising taxes. So if you're owning a business, your taxes are going to go up, and some of the taxes, especially the long-term capital gains tax, which many of these businesses have been held for a long time, that's going to see a serious increase. So the value of your company is going to be harmed when you go to sell it.
Well, let's expand upon that a little bit, because I can see where the baby boomers will be making their exit and passing the baton to Gen X as next up at bat. And they're in their mid-40s right now. What do you see long-term as risks and opportunities for these new business, well, not new, but taking over business owners?
Well, as I was just saying, the issue is for the baby boomers to retire and use the wealth they've created for that retirement. Now you start a whole new generation of business owners with a longer term horizon, likely 10 to 20 more years. So we're going to see all kinds of changes over that time, but you can't anticipate. So they're kind of open-minded about going into this endeavor with the expectation of growing a business and making it their retirement at some point.
Paul, when we talk about business owners nearing retirement, it's a little bit of a relative term, but at the end of the day, they have to begin to prepare for it. What advice do you have for a business owner that is nearing that retirement on how they can prepare for the day that they can retire?
Definitely. And one thing to put in perspective as well, the statistics tell us that there are over 4 million baby boomer owned businesses in this country. And if you assume they're going to be selling over the next 10 years, that's a flood on the market that's coming. So they're going to be in a race to get the best offer they can. And the way they do that is by preparing the business for exit via reduction of risk factors. A privately held business, and I use the term lower middle market because this definition is roughly 5 million in revenue to 50 million in that range. Those businesses don't have a lot of professional management, and they tend to operate in a comfort zone that the owner has had for 30 years. They do the same things the same ways, and they're not thinking about the next owner. So when the time comes, the next owner comes in and says, your business isn't worth what you think it is because you have issues. You have older equipment. You have concentration of customers. You have perhaps older employees at the management level, or you have lack of current marketing and sales processes. As we all know, everything is going digital. So you can go across the board and see all the things wrong in the business that the next owner will use as a method to discount. They're pushing the value down against you. So you have a flood of sellers, and you have pressure from the buyer side decreasing your value, all because you didn't prepare.
I like that thought, Paul, because in my business, I start retirement planning a good 10 years before someone retires. And I'm sure Ken does a lot of pre-work too before the homes are bought. So what kind of impact could exit planning have? And does your firm take an active role in that part of the business?
That's a very important question because just like you were saying, it takes time. If you're running a business and you don't have a lot of excess personnel hanging around doing nothing, so you're busy. And in order to make the changes, and we call it working on the business rather than just in it, those changes take time. So you have to start with a lead time, and we recommend 3 to 5 years. And if you make the changes, you'll increase the value of the business significantly relative to what it would be like if you didn't. And so it's a very important exercise to get involved with, but you need guidance because you know it's hard to do the things you've never done. You've never looked at your business from the outside in. You've never acquired another business in most cases, and so you don't know what the buyer is going to put you through in terms of due diligence, which is a very very serious process. When the buyer is spending millions of dollars to buy your company, they're going to ask you to prove a lot of things. And you can get that ready, or you can be under the gun while you're running your company and just feel like this is horrendous what I'm going through.
Paul, so we talk about exiting and what the options are for exiting, sale or passing it down. What are some of the options that business owners have for exiting their businesses?
Well, there are many options. Obviously, we represent mostly people looking to sell to a third party because that's a true liquidation. There is another version that is fits certain kinds of businesses where the owner can get their liquid value out of the business, and that's an employee stock option plan, ESOP. But it's managed by the government. There's a trustee involved, protects the employees' interests as they become the owner over time. It's usually a phased process. And it's costly in some cases. Another approach, if there's family in the business, is to sell the business to a family member. I never recommend giving it because there's no way that they'll run it well enough that you'll ever get the money you thought it was worth. So you need to get it out. They have to go find the funding. Those are the primary ways. It's third party employees or to the families.
Let me take you back a step, Paul, in case we have viewers out there that are thinking about selling their business. Could you summarize for us the most important factors in exit planning? Summarize it?
Yes. The one that we always say first and foremost is to make the business independent of you. Because how can you sell your business if you can't leave it without it failing or being harmed in some fashion? And that goes back to exit planning. It takes time to get yourself out of the business. I tell business owners, when you're just about ready to make that move is when you go away for a month to Florida and not a single employee in the business knew you weren't there. Because then you're not required to be there every day, and you now have turned over responsibilities to others.
So business owners can do this themselves. They can do their own exit planning, but often, but they don't. Why don't they?
Well, we all could do more exercising than we do, but a lot of us get a trainer to help us do it because it gives us a commitment. It gives us somebody to give us a suggested approaches, exercises we could try, and they can gauge how well we're doing. It's just like anything. You can sell a home for sale by owner, but we have professionals in the real estate world who help people sell homes. So you need to have a professional give you the advice. It's because it's not common sense. It's because you don't know what the buyer is going to ask in the first place.
That's very interesting. We've all been in that, there are certain things you can do yourself, and there are certain things that you really shouldn't, and you should seek professional advice. Timing wise, I really liked your comment about going to Florida for a month and nobody in the firm noticing you're not being there. Boy, I wish I could do that. But given that most business owners really couldn't get away with that, and they should be able to get away with that before they exit, how much time do you think they really need to do this exit planning?
Well, as I said, I recommend at least three years. Because if you're going to think about replacing yourself, you want to hire somebody and train them, and then give them some time in the role so that they're going to succeed on their own. You can't do that in 30 days. You won't even find them in 30 days. So you need to have a lead time that you can identify that issue. But then you have to do the other issues. Bring in accountants to make sure your financials are clean, and bring in other professionals. We recommend various professionals, whether it be CFO on a fractional basis, HR on a fractional basis, because these are small companies. They don't have professionals in all these roles, and these resources can help them do the things that take the risk factors out. So there's a time to do it. And back to one of the biggest issues is hiring your replacement. It's a mindset that they have to have as a business owner, because they know they can do that job. So they're hiring somebody to do what they could do, and they're using their money out of their pocket to pay this person. And they can't get out of their mind that that's a good idea. But the fact is, what they pay that person comes back to you in value when you sell many, many times more than you ever paid this person. So it's penny wise, pound foolish, whatever the old saying might be. But they have to think about this in the long term as part of the process of getting out. They have to spend the money now to do that.
Thank you, Paul. You have given our viewers a wealth of information. I do, though, want to take a moment and share with our viewers who our next guest will be on the program. And that is Luke Kemsky, who is the president of JPL Creative. Now, for your business owners out there, JPL Creative happens to be one of the Mid-Atlantic's largest integrated marketing agencies. If you can think of a way to market, JPL does it. But even more impressive is the fact that JPL has been voted best place to work for 18 consecutive years. And that says something about the quality of the firm. So be sure to stay tuned for that show. I think it'll be very much worth your while. And for Ken Jordan and myself and our guest, Paul Visokey, I very much want to thank everyone for watching today. And remember, your money matters.